So looking ahead to this week starting October 21st, we don't know yet whether a Brexit deal has been struck at the last minute at the time of filming. I'm being a little pessimistic and assuming it probably hasn't, and we're looking at another EU summit later in the month, but if it has, that'll be positively seen by markets. What we do know coming up this week is that the ECB is going to be setting interest rates once again, and we're in full flight earnings season, so we've got some top results from the likes of US tech company shares, for example, Amazon, Microsoft and Tesla. And we also have some UK banks reporting as well, Barclays and RBS, two that we're going to talk about specifically in this video. In terms of a market's backdrop as we head into the following week, well, it's been a generally positive previous week for equities. We saw US indices push into record highs off the back of a pretty strong start to Q3 earnings because of some good results, unexpectedly good results actually from US banks. We were expecting lower interest rates to hurt profits. They don't seem to have done so. So that's been a coup for US markets. Global indices have generally done well as well because we had the ceasefire or quasi-deal, you could say, between the US and China. So that's relaxed the trade war tensions somewhat. So as far as the currency market, you have to start with the British pound. That saw some major volatility just because of some vague hope that actually some sort of Brexit deal might be squared off at the last minute. And we've also seen other currencies do quite well against the dollar as well. The euro is still above 110. And dollar yen, that's actually a currency that's seeing the dollar strengthen a little bit, potentially an inverse head and shoulders pattern in dollar yen. Likewise, because the yen is a haven asset, it's doing badly, the dollar's doing well against the yen. Likewise, we've seen gold fall off a bit and potentially heading into the kind of correction that we've been talking about for a couple of weeks now. So let's switch gears now to the economic calendar. Big event of the week, as we mentioned, is the ECB interest rate decision, so I'll talk a little bit more about that in just a minute. Also, some decisions being taken by the PBOC in China. Interestingly, we do also have the federal election in Canada, where Justin Trudeau potentially going to come under some pressure because of recent scandals. So that'll be interesting for the Canadian dollar, particularly at the start of the week. Also got the ECB bank lending survey, which could impact European banks. In terms of the share prices. We also have durable goods orders from the US later in the week, which is expected to show a modest improvement over the month from last month where we saw a decline. And again, IFO expectations in Germany, given the difficult climate in terms of economic growth, they'll be well worth watching. We are expecting a decline in those IFO numbers. So I'm just going to run down the sort of broad picture for these individual tech earnings without getting too bogged down into the details. There's a few interesting company shares that we're looking at. So they're all quite mixed, which is interesting. Tech as a sector can often perform either all the shares doing well together or all doing badly together. It's more mixed than normal. So perhaps investors being a little bit more choosy about which specific sectors, even within the big FANG stocks that they go for. So if we start with Amazon, for example, earnings expected to fall 21% year over year. Remember, Amazon, a lot of the time, they focus on growth rather than earnings, so these earnings can be quite choppy. But still, with that earnings decline expected, the shares are expected to fall. The shares have fallen 8.5% since July, and the shares are indeed below the 200-day moving average. So in a medium-term downtrend at the moment. So if you are optimistic about Amazon's long-term growth prospects, they do seem to be dominating the retail market and being very innovative. Now is a value time to get into Amazon, but obviously in a downtrend, we don't quite know whether these earnings, if they disappoint, where we might see more declines in the share price, particularly with the momentum to the downside. Microsoft's earnings expected to rise 9% year over year. So the shares have done better than Amazon's. They're up 2% in the last quarter, and the shares are above the 200-day moving average. So a slightly different picture there. Not so much acceleration going into these earnings, but relative strength versus some of the other tech shares. So room for disappointment, you could argue, but the trend is up. Twitter earnings expected to fall 50% year over year. Again, very volatile, these earnings. And again, Twitter focus more on improving its infrastructure and the way it gets the adverts through the platform. And so in that context of improving its infrastructure and the way the business is run. Obviously, there are some extra expenses there, so profits are being hit. Nonetheless, it's had a very good year. 35% price gain over the year, 14% in this last quarter. 10% in the last quarter since June. So Twitter shares also doing particularly well at the moment. But these earnings, maybe they've been baked in already, and people probably, in the case of Twitter, are going to be looking more at the daily active users, which incidentally were up 14% in Q2, which is very good. We want it to be in the 9% to 14% range in terms of daily active users to show that Twitter's still getting its balance right to keep people coming back to the platform. Last but not least, Tesla. It's set to make another loss, so obviously profit not what's driving this share necessarily. It's at its 200-day moving average, having had a very good quarter. It's actually up 45% since June. If you remember in the previous quarter, it hit, I believe it was 97,000 vehicle deliveries. So again, not so much about the profit with Tesla, more about the deliveries of the vehicles. That was disappointing because it was just sort of the 100,000 mark, but nonetheless, it was better than expected. And so if they can deliver over 100,000, I think that would be very newsworthy, could be good for the share price, even off the back of what is kind of overbought levels at the moment. Now I'm going to switch gears to UK banks just lastly. Similar kind of analysis. We mentioned that US banks have done pretty well, so a bit of a high bar for the UK banks to follow off. But if you're talking about the domestic banks in the UK, which in this case I am to some extent, interest rates have remained fairly steady. Obviously, the Bank of England doing nothing while Brexit's taking place, so slightly different environment to the US. Nonetheless, Barclays, which I'll start with, does have a lot of US business. The adjusted earnings expected to fall 7%, but GAAP earnings expected to rise 80%. So depending on which one of those the market follows, the shares could move either way. They're up 24% since June, the Barclays shares. So to some extent, we've largely missed the boat if we're looking to buy in now. In a way, we're looking to see if these earnings could justify that price move, but I think probably the upside here is a bit more limited. What is notable, though, for those technical analysts out there is that it's broken quite significantly above its 200-day moving average, which was in a steady downward trend. We could obviously smash back below it, but it looks like there has been a bit of a shift in the technical trend in Barclays, away from a downtrend, perhaps more into more sideways movement, perhaps a basing pattern before some more serious upside if we start to say perhaps higher interest rates in the UK in the future. RBS, similar story, minus 21% drop in adjusted earnings. So there's obviously a lot of costs being added here, which meaning the adjusted earnings are falling, but GAAP earnings plus 65%. So underlying performance still looking quite good, plus 32% since June, these shares. So again, looking a little bit overbought. It's hard to see how these earnings can really justify that kind of price move. Might be set for a little dip. It's at its 200-day moving average, so at a bit of resistance here. So it could be a key moment for the RBS shares. So lastly, just want to touch base with the expected interest rate decision from the ECB. I say expected decision, probably nothing is going to change at this meeting, because if you remember, they did restart quantitative easing at the last meeting. I say restart, they announced it. The actual policy will begin in November. So the policy they just implemented hasn't even got going yet. So we're not expecting any change at this meeting. The backdrop is that there was a lot of dissent to that decision last time around. And the reports and the minutes of the meetings that we've seen since have seen pretty strong opposition from this, from the more typically hawkish members, the likes of Germany and Denmark and the likes. And so they've been talking about the unnecessary move back into quantitative easing. Maybe just an interest rate cut would have been enough. So the effort here will be from the ECB to kind of show a bit more groupthink, a bit more consistency in the message. We think there's a good chance they can achieve that in the short term. So in terms of euro, maybe we get a fall down from the top of the range, a little bit of a drop in the euro if they can show that kind of unity in this meeting. If they don't show the unity, we expect more euro strength. And if it doesn't happen now, the strength, I suspect once Christine Lagarde comes in as the new ECB president, and that's also set to begin in November, she may be under pressure to reverse course on this policy. So again, that might be a reason for some more euro strength. But I'm going to call it a day there. Thank you very much for watching this video, and if you do enjoy these and get some benefit, please make sure to follow myself and LCG on YouTube and social media.